Welcome to the Whitwam Wealth Real Estate Podcast. Today's episode is Become a Landlord.
Welcome to the Whitwam Wealth Real Estate Podcast with Scott Whitwam, your blueprint to financial abundance. Settle in as we explore the mindset and methods for wealth building through real estate.
Welcome back. I'm Scott Whitwam. On today's podcast, our topic is Become a Landlord. We want to become a landlord without going broke, right? That's partially true. I don't know anyone who really wants to be a landlord. Who wants to listen to complaints, fix units, update things, market? What we really want are the benefits. We want the positive income, the cash flows, the high returns, and the prosperity. And today we're going to break down how to become a landlord, a profitable one. First, becoming a landlord is not what most people think. Just buy a house, find a tenant, collect rents, boom, and shazam, you're rich. The truth is, being a landlord is a business, not a hobby. So today we're going to cover a couple key topics, and then in part 2, we'll wrap it up with the final 2 topics. Our 4 points that will be part of this are, first, our mindset and strategy. Are you actually ready to be a landlord? Number 2, we'll talk about finding the right rental property. Number 3, we'll talk about financing your real property. And number 4, managing tenants and protecting your investment. When we get to the end, we'll have the tools. You'll have the tools you need to become a profitable investor, to identify the properties you need and avoid rookie mistakes. So let's get into it. Number 1, mindset and strategy. Are you ready to be a landlord? Before you look at your first property, you really need to answer a basic question. Do you really want to be a landlord and begin generating passive real estate income? Being a landlord means you're responsible. You're responsible for people's homes, not just a spreadsheet. You deal with repairs, complaints, late rents, and occasional evictions. You make decisions that affect families, your bottom line, and all of this happens at the same time. If these don't sound like functions you'd like to deal with, you may benefit in this process from putting some of that responsibility onto somebody else, maybe hiring a property manager or having a more hands-off passive vehicle like real estate investment trusts, or as is better known as a RIT or even a syndicate. This is where the beginner needs to have a mindset shift. Because if you have a mindset shift and realize that you are starting a business and not purchasing a toy, that helps you to visualize, helps you to understand, helps you really to center on the next things you need to identify. Because your next one you need to identify is why. Why are you doing this? Ask yourself that question. Are you becoming a landlord to develop cash flow, leverage tax advantages, or develop long-term wealth? Or is it just because your buddy did it, your neighbor did it, you heard some talk show about it? How many hours a month can you realistically invest in managing a rental? So do you want to scale up? Do you want to start small and try to get up into multifamily and utilize tax strategies in order to scale to the place you want to be? Or do you want to build a large, inheritable portfolio of homes? And then once you've discovered this, then your why will determine what kind of properties you buy and where you buy them and how hands-on or how hands-off you're going to be. For example, if you want stable, slow, and steady wealth, you might focus on mid-range cost neighborhoods with long-term tenants. If you want high cash flow and are okay with annoyances, you might look at low-income areas with lower prices but higher turnover. But next, you need to do an honest personal assessment, a quick reality check. Are you willing to answer a call about a leaky pipe on Sunday at 9 o'clock at night? Are you comfortable with having difficult conversations about money, late rents, and lease violations? Are you organized enough to track leases, payments, repairs, legal documents? If not, that doesn't mean you can't be a landlord. It just means that you want to budget for a property manager right out of the gate, right? Because next you're going to have to decide your role that you're going to play in becoming a landlord. You've got 3 basic models. You can do it yourself. You can become a do-it-yourself landlord or a DIY landlord. You're the one who finds the tenants. You take the calls. You coordinate the repairs. This may provide better returns, but it'll also take more time and provide a little bit more stress to your environment. And this may be how you start with your first 1 or 2 rentals, though. A lot of people get started by doing it themselves. And then as your portfolio grows, you start to make some changes. Or you can implement right out of the bat a hybrid system. You may self-manage the properties, but you hire out certain pieces. Maybe you have a leasing agent that can find the tenants for you, or the realtor you used when you bought the property, if you used a real estate agent when you acquired the property, and you can help them find tenants for your property. Maybe you find a bookkeeper for accounting, have a handyman on call for minor repairs, or there is a third option where you go fully managed with the property management. You hire a property management company and you turn over a lot of the responsibility to them. Now, I want to say this too, when you're hiring a property management company and you turn over the responsibility to them, you are not necessarily just saying, okay, I don't ever want to see this again. I just want to see deposits in my bank. You still have to manage the property management company. You got to keep an eye on them. You got to look at the reports they send you. You got to make sure they're doing their job. Find out how often they've been out at the property, the assessments that they've made of the property. For that kind of work, they typically charge between 8 and 10% of the gross rent, plus some additional fees. A lot of times they'll have a tenant acquisition fee in addition to their 8 to 10% management fee. But interview several different property managers when you get to that point and find out which fits best for you. Sometimes it's not just the percentage they charge, but it's actually what they do for that percentage, for the money that you're paying them. And this will provide, less day-to-day pressure on you, but it'll also reduce your rate of return. There's no right or wrong answer, but you need to choose intentionally how you're going to handle the process. Once you're clear on your mindset, your goals, and your role, you're ready for the next big step, and that's finding financing, for the right rental property, and finding the right rental property. So let's start with number 2, which I'm going to call finding the right rental property. So let's talk about the part that everyone loves. Everyone loves a great deal. Everyone likes to find that property, that diamond in the rough. But really in the rental market, what makes a good or great rental deal? What determines a good or great rental deal isn't what you pay for the property. Now, that may enhance it, but that is not what determines a good or great deal on a rental property. It's how good is the rate of return on the investment. That's what's important when we're talking about buying, holding passive income. What is our rate of return going to be? Will rents cover all the expenses and still leave enough positive cash flow? Is there good appreciation in the area of the property? So there's maybe additional future value or an upside in case I'm scaling and want to 1031 out of the property, or maybe I want to sell it because I bought this rental property to provide cash flow while my kids were in school and then provide for their college. Or are you buying the property on a knife's edge and have negative cash flow every month? There's situations where having negative cash flow doesn't mean that you're losing money, right? Because you're paying down principal at the same time. And if you're in an appreciation market, you'll be making it on the back end. Now, I know what Robert Kiyosaki said. He says, never buy a property that doesn't have some positive cash flow to it. And I get that. But I've had some properties that I have purchased and done very well on that I've actually had negative cash flow because the appreciation of the property was going to be so great that we held the property for a certain length of time and then we scaled out of it. So you've got to know what that is. But if you're buying a property on a knife's edge or you have negative cash flow and it's not part of your model, it's probably not going to be a good idea. Is the area or property in a flat or value stable area so that there'll be little or no appreciation over time? You got to run the numbers, not just feel the vibes. There's a lot of investors that are just operating by the feel the vibe method and they lose money. But if you run your numbers it will help to stabilize your investing. When you're analyzing a deal, don't just look at the mortgage payment as the only part of an overall evaluation. List out the mortgage plus property taxes and insurance, any HOA fees, property management fees, maintenance. And you can also Google your area to search what is common or what is typical as far as a percentage of the rent for maintenance in the area. You can find out the same thing with regarding vacancies. I generally assume at least 5%. And again, every area is going to be a little bit different, but a good realtor or even an internet search can provide you with the proper percentage. Then you got to add in any capital expenditures that you're going to have on the property. When you buy it, you may know that you're going to have to do an AC or a roof or something. You're going to have to calculate that into your basis. And because it adds to the base of the property, it will be depreciable. There'll be some tax advantages to it. Optimally, you want your rents to cover and leave you with positive cash flow. If the numbers only work when everything goes perfect, then the deal doesn't work. Because if anything changes, if anything turns, if anything, interest rates go up, the market hits a stall, any of that kind of stuff, it can really turn the tides on your cash flow on the property. And lastly, choose the market you want to invest in. You don't have to invest in your own backyard, but you can. This is generally the best place for new investors to start. But if you're flipping homes or you're wholesaling homes in another area of the country, you may have better knowledge, may have more comfort with holding a rental property there. If you invest locally, it'll certainly be easier to self-manage. You know the area, you've probably lived there, you know where the hardware stores are, you probably have connections. But if you invest out of state, you'll potentially need to find some better returns, but you will have to heavily rely on other people. So we want to look at markets, obviously, that are supported by population and job growth, diverse employers. You don't just want a place where there's one big factory and everything's good because there's one big factory there. What happens if the factory shuts down? So you want to look for places that have growing employment, and then reasonable rent price ratios, so that that you'll have a strong continual rental of the property. You want areas to be, landlord friendly, or at least landlord neutral in regulations. There's some part of this country I won't buy properties because the rules and regulations favor the tenant so much that my cost on the rental generally doesn't mark out, and the additional frustration that it adds isn't helpful to me, because there's other places in the country where I can invest without having to deal with that. So we're going to close here for this part of the episode, part 1, on how to become a landlord. And as we're looking at these things, I want you, before next week, when we roll out the next episode, start to consider some of the things that we talked about today, because they are fundamental and they will have an incredible impact, knowing your why, changing your mindset, getting ready for what you're about to embark on, and then starting to identify the properties that will fit within your, I'm going to say within your class, but within your risk class, what you're comfortable with, the exposure. And what am I going to do with this thing? Is my intention just to keep one home? Is it to buy a whole bunch of homes? Or is it to scale? All these are important when you're building your mindset and building the basis for becoming a landlord. I want to thank you for joining me today on this episode of the Whitwam Wealth Real Estate Podcast. Hey, check out our previous episodes of related real estate investing topics. I invite you to subscribe today and be part of our growing community. You can always find the Whitwam Wealth Real Estate Podcast on Apple Podcasts, Spotify, iHeart Podcasts, YouTube, or wherever you enjoy listening to podcasts. This is Scott Whitwam. Be sure to join me on our next episode of the Whitwam Wealth Real Estate Podcast, where we're wealth building through real estate.